On the evening of June the 18th, 1815, a man stood on the coast of Belgium watching the horizon. His name was Nathan Rothschild. While 100,000 soldiers lay dead or dying on the fields of Waterloo, Rothschild had only one question: who won? He had spent a fortune building something no government possessed, a private network of couriers, boats, and riders stretching across Europe. That network was about to make him the richest man in England. A messenger reached Nathan in London a full day before the British government received official word of Napoleon's defeat. What he did next would become one of the most debated episodes in financial history. According to some accounts, he walked into the London Stock Exchange and began selling. The other traders panicked. If Rothschild is selling, they thought, Wellington must have lost. Prices collapsed. And then, at the bottom, Nathan's agents quietly bought everything that they could. By the time the truth arrived, Nathan Rothschild had made a fortune that would be worth billions in today's money. Whether this story is fully accurate or partly legend, one fact is beyond dispute. The Rothschild family understood something before anyone else. Whoever controls information about money controls the money itself. And for nearly 2 centuries, no family on earth would control more of it. To understand how one family came to dominate the world's gold market, you have to start in the Jewish quarter of Frankfurt in the 1760s. Meyer Amschel Rothschild was a coin dealer with a gift for making powerful friends. He became the personal banker to Wilhelm IX, one of the wealthiest princes in Europe. When Napoleon's armies swept through Germany, Wilhelm fled, but left his fortune in Meyer Amschel's hands. Rothschild did not just protect the money. He invested it, grew it, and used it to build a banking empire. Meyer Amschel had 5 sons, and he made a decision that would shape the next 200 years. He sent each son to a different European capital. Amschel stayed in Frankfurt. Solomon went to Vienna. Nathan went to London. Karl went to Naples. James went to Paris. 5 brothers in 5 cities, connected by blood, bound by secrecy, and operating as a single financial machine across borders that no government could fully see or control. This was not just a family business. It was the world's first multinational bank, decades before the concept even had a name. The brothers could move money across war zones, lend to opposing governments simultaneously, and profit regardless of which side won. During the Napoleonic Wars, the Rothschilds financed the British military while also doing business with French interests. They did not care about flags. They cared about returns, and their returns were extraordinary. By the mid-1800s, the Rothschild family was the wealthiest private dynasty on the planet. Some historians estimate their combined fortune at its peak was larger than any single nation's treasury. They financed railways across Europe, funded the Suez Canal, and lent money to governments from London to Rio de Janeiro. But it was their relationship with one particular commodity that would give them a power no other family has ever held. That commodity was gold. Gold was the foundation of the global financial system. Every major currency was tied to it. Whoever could influence the price of gold could influence every economy on earth. And the Rothschilds understood this earlier than any of their rivals. In 1810, Nathan Rothschild began buying gold on a massive scale to help the British government finance the war against Napoleon. He purchased bullion from the East India Company, moved it across the English Channel, and delivered it to the Duke of Wellington's armies in Spain. The operation was staggering in scope. Nathan moved the equivalent of hundreds of millions of dollars in gold through a private network, faster and more reliably than the British Treasury itself could manage. This was the moment that transformed the Rothschilds from wealthy bankers into something else entirely. They became indispensable to the machinery of empire. Nathan's bank, N.M. Rothschild and Sons, became the institution through which the British Empire moved its gold. And in the decades that followed, as Britain formally adopted the gold standard in 1821, the Rothschilds positioned themselves at the very heart of the system that would govern global finance for the next century. After the Napoleonic Wars ended, the Rothschilds did not step back. They stepped forward. They became the go-to intermediaries for central banks needing to buy, sell, or store gold. Their vaults in London held reserves for multiple nations. They refined gold. They shipped gold. They insured gold. Slowly and quietly, the family embedded itself into every link of the gold supply chain, from the mines to the markets. Then came 1919. The First World War had just ended. The gold market was in chaos. Currencies were unstable. Governments needed a reliable way to set the price of gold each day. And so, 5 banks gathered in a wood-paneled room at the offices of N.M. Rothschild and Sons on St. Swithin's Lane in London. They created what became known as the London Gold Fix. Twice a day, every trading day, representatives of these 5 banks would agree on a single price for gold. That price would then be used as the benchmark for gold transactions around the entire world. The chairman of the London Gold Fix was always the Rothschild representative. Always. For 85 years, from 1919 to 2004, a member of the Rothschild Bank sat at the head of that table. Think about what that means. Every central bank, every mining company, every jeweler, every investor, all of them bought and sold gold based on a price that was set in a room chaired by one family's bank. There was no government oversight, no public accountability, no formal regulation. Just 5 men in a room deciding what the world's oldest form of money was worth. During the interwar years, this power became even more significant. The gold standard collapsed and was rebuilt. Nations devalued their currencies. In 1933, United States President Franklin Roosevelt signed Executive Order 6102, making it illegal for American citizens to own gold. The price was reset from $20.67 per ounce to $35 per ounce overnight. That single decision transferred billions of dollars in value, and the men who set the daily gold price in London had advanced knowledge of the flows that followed. When the Second World War broke out, the London Gold Fix was suspended. It would not resume until 1954, but during those 15 years, the Rothschilds did not lose their grip on the gold trade. They continued to operate as brokers and intermediaries for governments moving gold reserves across the Atlantic, away from the threat of Nazi invasion. Vast quantities of European gold were shipped to vaults in New York and Ottawa. The logistics of who moved it, who stored it, and who profited from the transactions remain partially obscured to this day. The process itself was remarkably simple and remarkably opaque. The chairman would propose a starting price. The other 4 banks would call their clients and report whether they were buyers or sellers at that price. If supply and demand did not balance, the price was adjusted up or down. The process continued until the books balanced. Then the chairman would announce, "There are no flags," and the price was fixed. The word "fixed" was meant to indicate that a price had been set, but over time many began to wonder whether it also meant something else entirely. In 1971, everything changed, and everything stayed the same. United States President Richard Nixon ended the dollar's convertibility to gold, destroying the Bretton Woods system that had governed international finance since the end of the Second World War. Gold was no longer pegged at $35 an ounce. It could now float freely. Within a decade, the price exploded to over $800 an ounce. The gold market went from a stable, predictable backwater to one of the most volatile and profitable markets on Earth. And through it all, the Rothschild representative still sat at the head of the fixing table, now presiding over a market worth orders of magnitude more than before. During the 20th century, the Rothschilds expanded their gold interests far beyond the fixing room. They invested in gold mines across South Africa, Australia, and the Americas. They provided financing to mining companies. They offered gold-backed lending products. Their physical gold storage operations grew to rival those of central banks. In South Africa, the connection ran particularly deep. The Rothschilds were among the earliest European financiers of the Witwatersrand gold fields, the richest gold deposits ever discovered. They helped fund companies that would become the backbone of South African mining. For decades, South Africa produced roughly half of the world's gold, and much of it passed through Rothschild-connected refineries and trading desks before reaching the global market. At one point, industry insiders estimated that Rothschild-linked entities touched roughly 15 to 20% of the world's newly mined gold each year. The exact figure is impossible to confirm because so much of the gold market operates in private over-the-counter transactions where disclosure is not required. This was the genius of the Rothschild system. It was not about owning the gold, it was about owning the process. You do not need to control every ounce of gold if you control the mechanism that determines its price, the vaults where it is stored, and the channels through which it moves. The family had built a private toll booth on the world's most important commodity, and they collected a fee at every step. Then, in 2004, something unexpected happened. N.M. Rothschild and Sons announced it was withdrawing from the London gold fix. After 85 years of chairing the world's most important gold pricing mechanism, the family simply walked away. The official explanation was that the gold trading business had become less central to the bank's strategy, but the timing raised questions. In 2014, regulators in the United Kingdom, the United States, and Europe launched investigations into gold price manipulation. What they found was damning. Traders at the fixing banks had been sharing confidential client information, coordinating their positions, and deliberately moving the price to benefit their own trading books. Deutsche Bank, one of the 5 fixing members, settled with regulators and, crucially, turned over years of internal chat logs and emails as evidence. Those records showed a pattern of collusion stretching back years. Barclays was fined £26 million by the Financial Conduct Authority for failing to manage conflicts of interest related to the gold fix. Other banks face similar penalties in multiple jurisdictions. The London gold fix was abolished in 2015 and replaced by a new system called the London Bullion Market Association Gold Price, which uses an electronic auction with more participants and greater transparency. But here is the detail that few people discuss. The investigations focused on the period after the Rothschilds had already left the fix. What happened during the 85 years they chaired it remains largely unexamined. No regulator has ever conducted a full historical audit of the Rothschild era of the London gold fix. The records, if they exist, are private. Now consider the present. The Rothschild family no longer sits at the gold fixing table, but their influence over the gold market has not vanished. It has simply changed form. Rothschild & Company, the successor firm, manages assets worth tens of billions of dollars. The family's private holding companies control stakes in mining operations, commodity trading firms, and financial institutions across the globe. They remain one of the largest private clients of the London bullion market, and crucially, the infrastructure they built, the relationships with central banks, the storage networks, the refining partnerships, did not disappear when they left the fixing room. Those systems are still operating. Here is the pattern that emerges when you step back and look at the full picture. For 200 years, the Rothschild family did not just trade gold. They built the architecture through which gold is priced, stored, moved, and financed. They did this not through government power, but through private networks that operate below the level of public visibility. When regulators finally looked at the gold fix, the Rothschilds were already gone, leaving others to take the fines and the blame. Some call this good timing, others call it something else. Today, gold is once again at the center of global finance. Central banks around the world are buying gold at the fastest pace in decades. China, Russia, India, and Turkey have been adding hundreds of tons to their reserves. The old order, where the dollar was king and gold was a relic, is shifting. And in this new environment, the question of who controls the gold supply chain is more important than it has been in a generation. There is something else worth noting. In the past few years, the price of gold has reached all-time highs. It has surpassed $2,500 per ounce. Every time the price rises, whoever holds gold or controls the infrastructure around it gets richer. And the less visible you are, the harder it is for anyone to measure exactly how much richer you have become. The Rothschild family has been private for over 2 centuries. They do not file public earnings reports. They do not hold press conferences. Their wealth is distributed across a web of trusts, holding companies and family offices in Switzerland, the United Kingdom, and France. Estimates of their total fortune vary wildly, from a few billion to figures that strain credibility. Nobody outside the family knows the real number. The Rothschild model, private control over public infrastructure, influence without visibility, profit without accountability, has been copied by sovereign wealth funds, private equity giants, and commodity trading houses around the world. The family may no longer chair the fixing, but the system they designed, the system where a handful of private players determine the price of the world's most important store of value, is still the system we live in. The names on the chairs have changed. The room looks different, but the door is still closed. So the question is not really whether one family controlled the gold market. The historical record is clear. They did for 85 years, in plain sight. The real question is what replaced them, and whether the new system, with its electronic auctions and expanded membership and promises of transparency, is truly more open, or whether it is simply the same room with a different lock on the door.